because they do get a strike benefit while they're on the picket line, but it's nowhere near what their salary is. So it's sort of a complicated factor.
I want to ask you, you and Gabby and Josh, what did as you were feeling? Were they just, were they angry? Were they, I don't know, like how would you describe them? Was there a couple of words to describe overall the group?
Yeah, I don't know if there was a sort of a consistent theme there. I mean, it was almost, depending on the individual and what the individual circumstances were. Some were definitely angry, that they had to be out on this picket line. They felt like, this could have been avoided, that, the company, particularly with the company executives making millions of dollars, they feel like, there could have been more spreading around of the money and taking care of them without having to go on strike. Others are sort of happy, I would say, for the ability to fight for what they think they deserve. So while they would prefer, I'm sure, not to be on strike, they're certainly willing to, stand next to the barrel and wave the signs. And I think they're also encouraged by the support they're getting. If you stand on the picket lines in Detroit, cars passing are honking horns, and folks are bringing in water and donations to buttress the workers. So I think there's a sense that they are being supported in this strike.
Well, the reporting you did, and Gabby Coppola and Josh Idelson, it really just give us a feel of truly how these guys are feeling and why they are out on strike. So we so appreciate it. Bloomberg News Real Economy team reporter Mark Niquette joining us on Zoom in Columbus, Ohio. Hey, in just a few minutes, we're going to head over to a special interview here on Bloomberg as our Mike McKee is going to sit down with the Fed president of Richmond, Thomas Barkin, on a day where markets have been bouncing around. We had some weak consumer sentiment numbers this morning in terms of personal consumption specifically. So you do want to know and get a better feel, Tim, of what's going on in the economy.
Yeah, but tech leading right now. The NASDAQ higher by more than 1%, the S&P up by 0.8%, Carol.
Yeah, and listen, we're living right now from data point to data point as we also wait for earnings. So right now, let's head over to Bloomberg News International Economics and Policy correspondent Michael McKee sitting down to talk with the president of the Richmond Fed, Tom Barkin.
We'd like to thank everybody who is watching us on Bloomberg Television and listening to us around the world on Bloomberg Radio for joining us today, and thank Tom Barkin for joining us today. Most people don't realize probably that Washington, D.C. is in the Richmond district, so you're in charge. If your constituents shut down the government this weekend, is it a big deal for the economy?
Well, I'm pretty far from in charge, as you well know. Well, so look, we have a lot of workers who are employed by the government, and of course there are a lot of citizens who they serve, and this just creates uncertainty. And so I don't have any insight into how long this will last or what will actually happen, but as it plays out, there absolutely are implications.
Well, if it goes on for a long time, it is possible you won't have any of the government's economic data. You could go into the November 1st meeting without, say, jobs or CPI data. How does that affect what you do?
Well, of course, we economists want to think first and foremost about ourselves, so that's very good. But it would be hard to figure out what's actually happening in the economy without the jobs data, which is the best information on the labor market. It's hard to know what's happening in the economy without the inflation data, the PCE inflation data, which comes from the Department of Commerce. But we'll do our best. You take the environment as it is, and you do your best to figure out what's going on. And in my world, I just live every week on the ground, and I'm trying to talk to businesses and workers about what's happening in the economy, and I'll just double down on that.
Have you asked the Richmond staff to come up with any different kind of indicators for you?
Well, starting with COVID, we introduced collectively and have been tracking a whole different set of indicators. So I look at credit card spend, for example, as a good indicator of what's happening in consumer spending. And you can get that information, or we can get that information even weekly. There are a lot of alternative job opening databases, people who scrape online that we work with. So I think we're in a lot better shape now than we might have been 4 or 5 years ago, just because the uncertainty of COVID gave us a much more significant focus on real-time indicators.
Well, let me pick up on something you said there. You get pretty much real-time data on how consumers are doing. How are consumers doing? There's a theory out there that they're starting to pull back.
Well, the data on consumer spending, if you look at the last 2 or 3 months, has been extraordinary. And frankly, I think a little bit stronger than I see it, at least from the data I'm looking at. For me, it looks like it's okay. It's solid. It's not extraordinary. And we'll see if the revisions prove right. And we'll get more data tomorrow, obviously, on that. But I think it's solid. Now, you've got to segment it. So the higher end consumer still has money, still has wealth. Equity values have been up. House prices are up. And they're still spending, especially on things like experiences and international travel. The lower end consumer clearly is having to reprioritize spend. And then I've heard some interesting indicators lately that the middle income consumer is starting to reprioritize as well. And that would all make sense in the context of eroding stimulus, higher rates, and the like.
What do you think that means for the fourth quarter? Third quarter, all the measures, the nowcasts basically see very strong growth, anywhere from 3 to 5%. Do we fall off a cliff in the fourth quarter? Is a recession a possibility?
Well, if you define a cliff as 3.5% or whatever the third quarter forecasts are, I don't see that kind of growth rate continuing. And so you have to always worry about your baseline there. Growth still seems solid. You know, we're only 2 days away from the fourth quarter. And as I said, I still hear a pretty solid business climate. But I'm anticipating the next quarter or two to be solid, not to be robust. And that's how I see it.
Are you still in the camp that thinks, well, I guess you probably are, because there's nobody in the summary of economic projections who said that there was going to be a contraction. You don't see that coming for the economy?
I don't think the kind of growth we saw in the second and third quarter feels likely to continue. I think it's going to come off of that. How much far off of that, we'll see. And that's, of course, you know, we have the luxury of time, I guess, to figure out what does happen. We've also got these uncertainties. You talked about a government shutdown, auto strike, oil prices, and the like. There's a lot of things out there that could have an impact on the economy. So, you know, I think I'm going to learn a lot from the next several weeks and several months.
Well, that raises the question of the Fed left in the dot plot one more rate move for this year. Is that a placeholder in case of emergency, or do you really think we need another rate move to bring down inflation?
Too early for me to know. I think there are a wide range of possible outcomes. You could argue for a resurgence based on the numbers we've been seeing. You could argue for a downturn, as you've been talking about, and you could argue for a return to the pre-COVID economy. I think all of those are in sight, and you'd have very different, you know, medium-term rate paths against those outcomes. So that's why I like the chance to take some time and see what we see, particularly on demand, both core demand and labor demand, and then what we're seeing on inflation. And different scenarios for those things, I think, end up with different scenarios for rates.
I assume this means you're in the top line. There's only 2 lines for 2023 with one more move, or stay there. I presume you're in the top line that one more move could be necessary.
I'm in the camp of saying, let's see how the economy rolls out, and we'll respond appropriately.
What is your baseline forecast for the rest of the year, leaving these other possibilities out? I mean, you obviously can't know what's going to happen with the auto strike, et cetera. But let me expand it into the first quarter. Where do you see the economy going?
Well, I do think we're going to see demand soften. I just think that the combination of credit tightening and the rate impact, the lagged effect of rate increases has got to have some impact. So I've got demand softening. I don't think that's going to have the kind of trauma on the labor market it may historically have had, because people are still very loath to fire workers that they spent a year and a half trying to acquire. And so I think, in addition, businesses have been investing. It's been now 16, 17 months where the leading indicators have predicted a recession. Hasn't happened yet, but businesses in their 23 planning and now businesses in their 24 planning are being cautious. And so the combination of that means there's just not as big a cliff as you might expect, even were the economy to slow.
But what are they telling you about employment going forward? Because you've raised rates 11 times, more than 500 basis points, and the unemployment rate basically hasn't moved. Are they hoarding workers at this point because it's hard to find them? Are they prepared to start laying people off, or do they think they can power through?
I think you've got 2 segments on the labor side. I'll call it the professionals and the non-professionals. The non-professionals are really the part that were short during COVID. And you'll notice if you look at these layoff announcements over the last 6 or 9 months, they're almost all professionals, support and overhead type of people. The skilled trades, the frontline workers, for the most part, aren't being affected. And that's because people are really worried you'll be able to find replacements should the economy come back. On the professional side, while there have been dislocations, that's a group that repots relatively quickly. And so you're not seeing it in the unemployment rate because they typically run unemployment at about 2%. And so it's just a very much lower unemployment group that can find other things to do. And so the dynamics of the unemployment rate are actually just different than, the kind of downturn that we're used to, like the one in 08, which hit the people last in the workforce and the manufacturing and the construction workers the hardest.
Well, do you still think that unemployment has to rise in order to bring inflation down? Jay Powell promised pain, but so far you're sort of disappointing the masochists.
You're saying he's under-delivering on pain? No, I think what has to happen is it's very hard to imagine inflation settling while the economy is growing at significantly faster than trend. That just is a strange thing to believe. You'd have to believe it's all supply. And I think while supply has been a big part of this, it's not all of it. We've unleashed, unfortunately, people's ability to use price as a lever, and they will use it until it comes down. So I think there'll have to be some softening. But as I said, I don't think that softening is likely to hit the labor market in the kind of way that we're used to seeing because of this issue of people retaining workers and because of the issue with people who have already been cautious, with their hiring.
What are business leaders telling you about wages? Are they able now to bring down the increases and get them to a more sustainable level?
So if you think of merit pay, and most everyone I talk to is thinking about the end of the year merit pool, maybe it was 2 or 3% normally. Maybe last year it had to be 5 or 6% because of inflation. People clearly are seeing that coming down. Maybe half the people I'm talking to would say it'll be like it used to be. The other half would say maybe it'll be 3 to 4, not 2 to 3. And so I think bringing down price inflation overall has brought down those kind of expectations. The place where you're still seeing wage pressure is skilled trades. And, construction workers, even I've heard people who, assistants in veterinary stores, places where you need a degree, where demand has shifted up, nurses, and we just haven't had the supply. That's still a place that's got meaningful wage pressure.
I have to ask you about the bond market. You heard the anchors talking about the markets before we came on here. We've seen yields rising to levels that we haven't seen basically since the great financial crisis started. Does that worry you? Does that encourage you? How do you feel? How do you look at the bond market?
I don't know how people look at the bond market every day and keep, happy or unhappy. It seems like it moves. So I try not to spend too much time focused on it. What I will say is that financial conditions are the way that monetary policy work their way through the economy. Financial conditions, at least the part which were bond rates and equity values, actually loosened over the summer, and they're tightening back up again. And so I take it as one of many indicators that financial conditions are tightening, and then I'm looking to see whether that tightening has the kind of impact on demand and eventually inflation that we would want.
Is that one reason that you took some of the cuts for next year out?
Well, everybody did their own version of the SEP, and as you well know, it's a median, so it's not any one person's thing. But I think as I looked at the SEP, what I saw was stronger growth forecasts. I saw lower unemployment forecasts, and I saw inflation the same. And the only way those three things square is with the fourth thing, with this less accommodative monetary policy.
One more question. Tomorrow we get the PCE numbers for August, and there is the people who do the math on these things say if it comes in as forecasted at 0.3 or 0.2 on a month-over-month basis, it sets you up to come in below your brand new forecast for PCE. Do you think that maybe you're doing better than you give the impression in terms of bringing down inflation?
Well, the last 5 months of inflation, and they've been restated, as you know, have been encouraging. If you look at the last 5 cores, they've been 0.3, 0.3, 0.3, and then 0.2, 0.2, and there are a lot of people who estimate another 0.2 tomorrow, and of course, on a 6-month basis, that means you're at 3%. And I think on a 12-month basis, it would be 3.5 or something like that. So that's encouraging, and nobody in my shop is rooting against lower inflation. So we'd be very happy with that. We'll see what happens.
All right. Tom Barkin, thank you very much for coming in today, the president of the Richmond Federal Reserve Bank. We'll send it back to you.
All right, Michael McKee, thank you so much. Bloomberg News International economics and policy correspondent Michael McKee sitting down. Another great conversation with a Fed official, the president of the Richmond Federal Reserve Bank, Thomas Barkin. And I think what was kind of interesting, you and I kind of chuckled when Mr. Barkin says he doesn't know why people are so obsessed and focused basically on the bond market. I don't think he said obsessed, but focused he did. And I'm like, okay, maybe that's our cue to like stand down a little bit.
I love it. He said, quote, I try not to spend too much time on the bond market. You and me both, friend.
I mean, I'm bringing that up with our friends in the simulcast. I'm just going to say.
He did also say that the government shutdown creates uncertainty and sees next quarter as solid, not robust. What I found really interesting, Carol, is he said it was very hard to imagine inflation settling while the economy is growing significantly faster than trend.
Yeah, I think it's kind of interesting. He did, though, talk about doesn't see 3% growth rate continuing. He did say growth, though, still solid. Next quarter growth expect to be solid, not robust. So maybe a little bit of a tempering. But it is interesting what he had to say when it comes to the inflationary environment.
Too early to say whether another hike is needed.
Tick, 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 tick. Data dependent, anybody.
We're getting some data tomorrow.
All right, we do indeed. But bond market, stand down, everybody. Slow
That's
your
your
roll.
favorite part of the interview, isn't it?
It certainly is. All right, right now, though, a lot going on this Thursday. And all over it, of course, is Charlie Pellet. He joins us now with a Bloomberg Business News Flash.
Thank you very much, Carol Master. 15 minutes to go ahead of the closing bell. The Dow, the S&P, NASDAQ remain in the green. We've got the 10-year, 4.57%. The 2-year, 5.06%. You heard him live here on Bloomberg Radio. Richmond Fed President Tom Barkin, interviewed by our Michael McKee. Yes, he discussed a number of topics, including what a government shutdown might mean for his district, which includes Washington, D.C.
It would be hard to figure out what's actually happening in the economy without the jobs data, which is the best information on the labor market. It's hard to know what's happening in the economy without the inflation data, PCE inflation data, which comes from the Department of Commerce. But we'll do our best. You take the environment as it is and you do your best to figure out what's going on. And in my world, I just live every week on the ground.
And you can hear more of that conversation on the Bloomberg Business Week podcast. You can download it wherever you get your podcasts. Stocks higher, as I mentioned, right now we've got the S&P at 4,300 even. Got to keep it locked into Bloomberg Radio to see where we close 14 minutes from now. S&P up 25, a gain of 0.6%. The Dow up 113, up 0.3%. NASDAQ Composite Index up now by 0.8%. Spot gold down $8 the ounce to 18.66, a drop there of 0.4%. And West Texas Intermediate crude down 2%, 91.80 a barrel on WTI. Again, recapping 10-year 4.57% with a 2-year right now 5.06%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody, just about 13 minutes left in today's trading session, kicking around, bouncing around. Definitely off our lows of this session here. Charlie just breaking down those numbers for you. So much of the week, and I feel the last couple of weeks, and since that latest Fed meeting, we've been obsessed with what's going on in the rates market. And you are seeing rates pull down a little bit. We talked about consumption spending, personal consumption spending. It is down some data points this morning. And then, of course, we just heard from...
Tom Barkin.
Tom Barkin.
From the Richmond Fed, president of the Richmond Fed.
Yeah.
Carol, what did he say about the bond market?
Slow your roll, everybody. Stop being so obsessed.
There's one takeaway Carol had from that 12-minute interview that Mike McKee just did with the president of the Richmond Fed. It's try not to spend too much time
because we parse over every little move.
I mean, the bond market. Well, let's hear what Samir Samana has to think about the bond market. Samir Samana is Senior Global Market Strategist at Wells Fargo Investment Institute. He's joining us in our Bloomberg Interactive Brokers studio. Okay, before we get to the bond market, you're expecting more weakness in equities with the S&P 500 now below its 50-day and 100-day moving averages. Talk to us a little bit about the equity picture for the rest of the year.
Yeah, I mean, look, with rates doing what they're doing, sorry to talk about the bond market. I know we're supposed to all just
You're
be
done.
calm
You're
and
out.
cool about it. Yeah, but I mean, rates are basically a soft cap on valuations, right? And you're, trading at basically low 20s on the S&P right now, at least based on our earnings number, and that's just too high with rates being as high as they are. So, in our opinion, probably fair value somewhere in that 4,000 to 4,200 area. Now, it could be that we end the year at those levels because, again, we think a recession, starts to kind of, unfold at the very tail end of 2023 into early 2024. But we would be pretty cautious on equity markets here.
What's interesting, too, though, is I am thinking about, you said like a value cap, right, in terms of the higher rate environment when it comes to the equity side of things. But if growth comes in, right, Tom Barkin mentioning it's hard to see inflation coming down because of the growth picture. How do you kind of strategize around higher rates, but maybe a fairly okay growth environment? So what does that mean for the value cap, or what is the right value cap then?
Well, that means inflation doesn't come down, and that means the Fed has to revisit rate hikes, and or the long end has to do the work for the Fed because they're on pause, which means maybe 5% isn't the right level for long rates. Maybe it's something even higher.
But if we have growth in the economy, even in a higher rate environment, like what's the right thinking in terms of what equity valuation should be?
Well, eventually those higher rates will put downward pressure on growth, right? I mean, when you look at what's going on with existing home sales, right? I mean, I think turnover this year on existing home sales was like 1% throughout the economy, right? And when you think about basically that big a part of the economy that's just frozen, right? People aren't moving for jobs, they're not selling their homes, the realtors aren't earning the commissions, you're not redecorating a house after buying it. Again, you're going to see that more and more on things like autos and maybe even things like, your credit card. So we think after the holidays especially, people are going to hit a pretty strong wall, with respect to the consumer. And it's just very difficult for the economy to continue going if the consumer's hitting a wall.
So the weakness in terms of the consumer side of consumer spending picture, which I know some analysts, I think the Nike downgrade, and I think, or Nike, right?
Or the concerns over Nike about the consumer.
Right, exactly. So some concerns about consumer spending. You think we're going to see that and it's going to be rough?
We do. I mean, look, the Q2 GDP came out this morning, right? And the part that was revised down by 50% is personal consumption. And that was Q2. So that was before oil prices and gas prices did what they're doing right now.
Okay, so it's not sounding that pretty. What does our investing audience need to know about?
Did you use the word recession?
I did use the word recession. I did. I mean, look, we would focus on larger cap, U.S. equities. We've been favorable there for almost as far back as I can remember. On the flip side, we'd avoid smaller caps in the U.S. and we would avoid emerging market equities.
Although their valuation play looks a little bit better than larger caps right now.
Yeah, they're cheap for a reason, though. Okay. I think that's the tricky part. Is those are value traps. So now, when the cycle turns, you're absolutely right. Those valuations have a lot of room to expand, but we wouldn't mess with those until you get to the recession.
Do you think there's more downside to the S&P 500 this year?
We do. We would not be surprised to see us trade with a 3 handle during the midst of recession.
So,
when would the midst of recession be?
So we would probably say early part of next year. Again, it probably starts later this year and probably bleeds into 2024.
I think of, Tim, this conversation we had with Peter Atwater of William & Mary, and of course runs his own financial insights firm. But I do wonder if, and his concern was, are we missing some of the bad stuff, right?
Yeah, but he's been concerned about that for months.
He has been, but there's this feeling out there, we're going to bounce back, because we have been only bouncing back thanks to stimulus and so on and so forth. But I do wonder if it gets bad, and if we do get a recession, is it wide, deep, long?
So we would say moderate.
Not really know? You say moderate.
We would say moderate, and we would say a couple of quarters. I think what you have to watch for is the Fed's reaction function. Is how quickly do they switch from inflation fighting mode to propping up the economy mode? And to the extent that the Fed is late, to the extent that they're focused on inflation, which is probably the most lagging indicator of all time, I think that's where things could get really tricky.
I have so many questions here. Fortunately, we have a few more minutes. Samir, when would you think the Fed would need to start cutting rates, given where you think a recession is happening?
I mean, it's probably going to be the middle to later part of next year.
Speaking of slow your roll.
Yeah. I mean, they're going to be...
Remember we used to talk about rate cuts this year?
I know.
I think they may compound the inflation is transitory mistake with a possibility that disinflation is transitory mistake, right?
If you're saying that it's such a lagging indicator, then ostensibly what you think the Fed needs to do is cut rates earlier than anticipated.
Well, I mean, again, first I think we have to enter the recession, right? I mean, as part of the kind of slow your roll theme of this interview, right? I mean, they can't cut until we actually see the recession. You can't see the recession until financial markets comply, right? Because right now they're all out fighting the Fed, right? When you look at credit spreads, when you look at equity multiples, I mean, the market isn't making the Fed's job terribly easy.
Okay, what happened here? Because 6 weeks ago, Carol, all we were talking about was a soft landing. And you had, adjustments coming from so many of the major banks.
It's the pig pile. Everybody pig piles on.
Saying, okay,
that's what you run into.
And then even, a recession wasn't a base case for the Fed anymore. What happened, Samir? What changed?
Look, 6 weeks ago, I went through probably the roughest, stretch that we've had this year, right? With respect to, you guys are crazy. This is a new bull market. You've missed it. My clients have too much cash. great job. Thanks a lot.
So
right?
mid-August?
So June, July,
June,
right?
July,
When we hit
yeah.
4,600.
Before we got to August.
And, we have this 4,000 to 4,200 year-end target for 2023. And we were basically talking to clients, to advisors, and saying, look, this will turn. I mean, this can't keep going because, again,
Why was the street, though, constantly playing catch-up and ratcheting up their numbers? To me, it's always a contrarian indicator when everybody piles on.
That's exactly how I viewed it as well. And you could see that in the flows data. You could see that in sentiment. And that was the reason why we were like, look, fundamentals matter. You can't just base a whole, investment philosophy on sentiment, technicals, and momentum.
So what's your end of year target for the S&P 500 now?
It's 4,000, 4,200 for this year. That being said, it's 4,600 to 4,800 for next year. So again, as we get those opportunities.
Wait, what is it for the end of the year?
4,000 to 4,200, right?
Oh, 4,000 to 4,200.
That's for this year, and then 46
year?
to 48 for next year, exactly.
Okay.
So look for opportunities for those brighter days ahead.
You're a global market strategist, so that to me says you can kind of go anywhere and go into a lot of different asset classes.
Yeah.
What's your number one investment idea right now?
I would say commodities look really interesting to us. We've been favorable for a long time. We think we're in a bull super cycle for commodities. We think they're a great diversifier. And what's going to surprise
all commodities,
people?
Or?
We really like a basket because in a bull super cycle, what you tend to see is different commodities tend to come in and out of favor. And so rather than individual clients trying to figure out which commodities currently most in favor, just own a broad basket. And then I know it's probably a little bit.
How much of it is the energy story, or it's not just that?
A lot of it's the energy story, but I think a lot of it's just supply discipline. You've just had a lot of folks that overinvested in supply during the go-go China years.
Yeah.
And with China having really slowed down, a lot of the supply discipline is going to find its way into those higher commodity prices.
We have a great story about ag and supremacy, U.S. supremacy in the agricultural world and how that has shifted. It's at the end of our broadcast, so highly recommend everybody stick around for that.
Hey, Samir, you said avoid small caps and avoid emerging markets right now. What else should you avoid?
We would avoid the consumer. We would avoid consumer discretionary.
So like Nike.
Like Nike, exactly. And we would also, avoid real estate. We don't like REITs. Again, they're hit only, not only by higher interest rates, but also all these issues surrounding probably a economy that's still probably over-retailed, over-banked. All these physical spaces probably will kind of be reduced over time as we all move online.
What's like the number one you think about when you get up in the morning and you're thinking about the market and the environment?
Right now, it's oil. I mean, if there's one chart to watch, it's oil because, again, it's tripping rates. It's firing up the Fed with respect to what does this mean for inflation. That's the number one chart I'd have my eyes on right now.
Yeah, really interesting. And from the Fed speakers, do you pay attention? I mean, forgive me, Mike, we love you and anybody you talk to.
I pay attention.
But do you look for little nuances?
I think the Fed kind of gave up some of their importance when they said that they're data dependent, right? It's the transitive property in math, right?
Yeah.
If the Fed's watching the data and I can watch the data instead of watching the Fed, I'll just watch the data. And I'll go even a step further. I would say the markets usually tend to run a step ahead of the data.
Yeah.
And I think that's what's telling the story right now is when you look at smalls relative to large, when you look at what's going on with certain parts of the credit markets, I mean, that's really where the game's being played.
Well, thank you for playing, speaking of games, playing along with the slow the roll kind of game today.
That was fun. That was fun.
This week.
Come back, Samir.
So appreciate it. Samir Samana, Senior Global Market Strategist at Wells Fargo Investment Institute, joining us here in our Bloomberg Interactive Broker Studio. I know it's Thursday, but have a good weekend. All right, Carol Master, Tim Stanovic, we're heading over to our TV colleagues. We're going to count you down to the close beyond the bell. It starts right now.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Katie Greifeld. We're counting you down to the closing bell. And here to help take us beyond the bell, Carol Massler, Tim Stanovic joining us once again here. Welcome to our audiences across all of our Bloomberg platforms. The price action in the equity market about the same when we last left you, Carol.
Yeah.
But a big reversal in the Treasury space. The sell-off has actually turned into a big bout of buying.
Isn't that interesting in terms, and what do you think it was that maybe Tom Barkin said, telling Mike McKee, of course, the president of the Richmond Federal Reserve. I mean, for me, what was really interesting is how he said he doesn't watch the bond market.
That was Carol's favorite part of the
Why are we
interview.
so focused? I'm like, he's like basically saying, slow your roll, everybody. Just kind of let it be. But I thought it was interesting, and then to have that kind of bond market reaction, whether it was off of some of his comments or what, I don't know, guys.
Hey, how did you guys find Samir Samana just now? I know you spoke to him before we did at the Wells Fargo Investment Institute. We just spoke to him, and I would say the conversation was, Katie, not quite upbeat. He's calling for a recession early part of next year. He has a year-end price target of 4,000 to 4,200 on the S&P 500. He's worried the Fed's behind.
I wonder who he liked more. Did you ask him that?
He definitely liked us.
Okay.
Yeah, more. Yeah, no doubt.
Yeah, it was interesting. I mean, speaking to him also, pretty bullish on commodities, though, to pair with that. That was pretty interesting as well.
Yeah, I mean, and he didn't seem too dour. I mean, he seemed to suggest that,
maybe we bring out the
there's
worst in
some issues,
people.
but when you go, I mean, Carol has that effect sometimes. But, when you get deeper into 2024.
Again, I can hear
he
you.
seems to suggest that. And I actually listened to part of your interview you had with him.
Thank you.
Yeah, it's,
Really?
yeah, believe it or not, I do listen to you
love
guys.
us? Okay.
I mean, love is a strong word, but I like it, guys. All right, guys, let's walk through the numbers here on this Thursday afternoon. Higher across the board for all of the major indices here in the U.S. The Dow Jones Industrial Average up by more than 100 points, back around that 33,600 level, about a 0.3% gain on the day. The S&P 500 just a smidge below 4,300, higher by about 0.6%. The Nasdaq Composite higher by 0.8%, and the Russell 2000 posting a similar move higher, about 0.9% on the day.
Yeah, it was kind of like a Sybil kind of day. I feel like we trade like that, right? It's like multiple different trend lines in a day, if you will. But in terms of the equity markets, what really caught my attention was what went on with the SOX, the Philadelphia Stock Exchange Semiconductor Index. 29 of the 30 names higher in today's session. The index up 1.8%. Micron, obviously, a bit of a bummer, and that was the only name that was down on the day on that forecast for a worse than expected loss. But man, Katie, that was definitely a group that was a standout in today's session.
Yeah, really interesting to see the rest of the industry rip on a day where Micron obviously did the opposite of that. You take a look at some of the industry groups. You also had autos having a good day, up 2.4%, and then semis, as we were just talking about, up 1.7%. Those were your biggest gainers. You go down the list, there were a few names in the red, not too many, but down there at the bottom you can see utilities once again in the red. That's some more defensive play, and the mood music was pretty good today, so utilities off about 2.2%.
The mood music?
The mood music. I say that all the time. I
Do
need
you?
something else.
I like that. All right, let's get to some of the individual gainers, if we may. Peloton atop that list, at its highs up more than 12% in today's session, finishing with a gain of about 5.4% on heavy volume, I should point out. News after the close last night, agreeing, I think we all were breaking it down, but we got some more color on it, agreeing to a deal with Lululemon to tap its online workouts and team up on apparel. Lululemon's going to make co-branded clothing that Peloton will sell on its website and at retail stores, and Peloton, meanwhile, will be offered to users of the Lululemon Studio Mirror. So a lot of integration back and forth there. So nonetheless, investors moving into that name. But, I just want to do a quick check. I think Peloton still down almost 40% for the year. And you did have Lululemon.
Why don't you do it from the highs?
Well, I
think that would start with a 9.
I had to give it a little bit of love.
And I just want to point out, I'm glad you mentioned the volume on that too, because I mean, that's kind of one of the things that's held this stock back. There just really wasn't a lot of interest in trading it up or down. And I think we were something like 4 to 5 times the average daily volume on this day, 47 million shares.
Where was it at a time? I'm just going to pull it up here.
Yeah.
It was like, what was it? It was a $167 stock, closing the day just under $5. So yeah, you're right. Okay, good point. Advanced Micro Devices, one of the semiconductor names. I just thought I'd throw it in there. Up almost 5% in today's session. As we said, no real news. Also on heavier than normal volume. Shares have gained about 60% year to date on that interest in AI. So just wanted to point that out. Chico's. This was an interesting story. I thought this was really interesting.
Yeah.
Up 63% in today's trade. What?
Yeah, no, go ahead. I mean, I'm fascinated by this. I mean, this was like, you talk about a fallen angel.
Absolutely.
Yeah.
But Sycamore Partners apparently finding some value, I guess, in this name, and you wonder about what they will do with it. $7.60 per share in cash. Stock closed just below that at $7.52 a share. Brands, of course, White House, Black Market, Chico's, and Soma. But I always feel like, those retail names, even though when they fall on hard times, there's always like a buyer, often in the investment world, that finds
But can they
something.
kind of get that cachet back? Because it seemed like there was this
I don't
period, I don't know, like 10, 15 years ago where they were kind of all the rage amongst like, a certain cohort of women. And then it just kind of, I don't know, it just never really evolved, the styles or anything. And I don't know, if Sycamore could do something with it, great, but I don't know.
I actually, no kidding, I have a Chico's cardigan sitting at my desk right now.
Do you really? Right next to your hocus?
Are you that sort of kind of women? Like, how did you
I don't know,
describe-
apparently. I don't
Biggest
know.
biggest move since 1993
Well, it's
when
massive.
the company went public.
Wow.
There you go.
Highest at the highest level since 2018.
I remember where I was in 1993.
Do you?
Yeah.
You don't?
I was barely alive.
All right, let's
Thank
do
you,
decliners.
Yeah.
Carol has the gainers. I'm going to go ahead and do decliners.
This is what she just
CarMax
said
finishing the
before.
day down more than 13%.
focused on
Biggest
the bond
decline for
market right now.
CarMax in more than a year. Shares falling after the company fell short of analyst profit estimates for the current quarter. Sales lower amid higher interest rates, higher rates for loans weigh on the used car business, of course. CarMax, get this, said the decline in profits was the result of higher prices, higher rates, tightened lending standards, and lower consumer confidence. Used vehicle sales down 7.4% from a year ago. The company's CEO telling investors that some customers are trading down to different cars so they can afford those higher payments. When interest rates go up, that means those monthly payments go up. Shares of Micron finishing the day lower as well. They fell after the company predicted a steeper loss than anticipated in the current quarter. Shares down 4.41% today. That indicates an industry slump is still weighing on the largest U.S. maker of memory chips. And shares of Workday falling the most since 2020. This after the company trimmed its long-term forecast for annual subscription revenue growth. This was during an investor presentation earlier today. Shares down by 8.5%.
All right, let's take a quick look at what went on in yields. At some point on the day here, it looked like we were going to get a continuation of that bond sell-off, but we did see a reversal here late in the session here with some buying coming back in, and of course that ended up shifting the curve down across the board, down about 7.5 basis points on your 2-year yield. On the longer end of the curve, it was a little bit less dramatic, only about 1 or 2 basis points there here. But it really gets more to this whole idea, guys, of just the volatility that we continue to see in the Treasury space, a Treasury market that, of course, is supposed to be the most liquid, the less riskiest, and of course, it's trading on certain days like a meme stock. And of course, Tom Barkin says he doesn't even pay attention to it. I should point out here, I mean, since I know how much you love Fed speak, Carol Massar, that Jay Powell is actually speaking right now. He's actually hosting a virtual event. This is basically a town hall with educators. You see him there on the screen there, basically talking about education and I guess that education is good. We're going to listen into that and bring you any headlines as we get them. If you do want to listen into it yourself, just type live go on the Bloomberg terminal.
And we do know that Jerome Powell definitely pays attention to the bond market. Last Wednesday, of course, he mentioned real yields a number of times. Of course, that is yields that take into account the impact of inflation.
I thought that was the name of your show, Katie.
It is, actually. And real yields, again, when you strip out the impact of inflation, that is, they're extremely high right now. I know we've been spending a lot of time talking about the size and scope in nominal yields, but the real yield matters because you think about the borrowing costs for all of these companies that we talk about all the time. That's what it is. That's the tightening of financial conditions.
Can we go back to Jay Powell? Because I'm just reading Craig Torres and Laura Curtis putting out a story, and Jay Powell saying the Fed's ability to influence the economy depends on whether, quote, people understand what we are saying. When Fed officials publish their projections for interest rates in the economy, quote, one of our goals is to influence spending and investment decisions today and in the months ahead.
Well, we know they influence the decision-making of executives at companies, but I don't know, Romaine, how much the actual regular person who's going out and spending money actually cares what the Fed has to say about inflation.
But he's talking about people like understanding, like their financing.
Well, inflation
and
expectations are very
Fed,
important, and that's why high oil prices are such a concern for the Fed.
Yeah, but it gets to the idea too. Like, I mean, he doesn't necessarily have to speak to, the people on the ground. You speak to the financial markets and the economists, and in theory, that sort of message trickles down. And we know that this is a Fed, at least in terms of policy, where the communication mechanism today is probably way more important than the policy change itself.
If you're going to, I don't know, going to the grocery store and it's like, $18 for a pound of deli meat, do you need the Fed to tell you that inflation is high?
Yeah, but maybe you'd like to hear the Fed say that they care a lot about it and explain in plain English what they're doing about it.
Well, I just printed up all these little stickers of Jay Powell, and it just says, I did that, and I put it right next to the price of eggs.
That was you?
Yeah, that was
really?
me. Yeah.
Wow.
Yeah, I have a lot of free time.
Apparently.
This show isn't my life.
Don't you feel like every
just
day,
3 hours.
everybody, we learn something new about Romaine Bosnick?
Try.
You don't want to know.
I know.
I still love that suit.
Thank you. Thank you, Tim. I love the suit too.
I love when the guys
Very
do
nice.
this. Where's your tie, Tim?
No,
Still
That's
learning
him.
to tie.
Tim hasn't worn a tie since 1993.
That is true.
He has not. All right, guys, that's a wrap. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. We will see you again. It will be Friday tomorrow. Join us for our coverage at 3 and 4 p.m. Them. Meta Platforms, though, shares higher on today, I should say, in the trade after analysts weighed in positively on the AI potential of the new artificial intelligence features that we talked about yesterday. The company unveiling its annual developers conference yesterday, unveiled there. Wall Street Journal also reporting earlier this week that OpenAI, the company behind ChatGPT, Tim, exploring a sale of shares that could value the company up to $90 billion. That's a pretty big deal.
It's a huge deal. Okay, so we know we can, use AI to chat with Tom Brady if you're soon if you're using Meta Platforms' new thing, or Snoop Dogg, or help you with recipes if you're using ChatGPT. But what about AI when it comes to medicine, Carol? How can it help doctors make better decisions and ultimately make us healthier and live longer?
All right, well, with us to talk about that, Elizabeth Staudinger. She is managing board member at Siemens Healthineers. It's a $57 billion medical tech company that does medical imaging, testing, diagnostics, and more. Delighted to have her with us on Zoom from Munich, Germany. Elizabeth, thank you so much for joining us on Bloomberg Business Week. I think we are all curious about the value of AI as it starts to seep into all walks of life, personally and professionally. Give us some insight about how you all are thinking about it.
If you think of a world where getting healthy and staying healthy is a right and not a luxury, regardless of whether you are in Vietnam or a head of state. If that's a vision you want to buy into and you believe in, then AI actually can be one of the levers that can help us get there.
Okay, so what does that look like in terms of diagnostic imaging? I mean, this is one I think about a lot. We have people reading mammograms, and people reading mammograms miss things. They make mistakes.
That's absolutely right, because reading mammograms is not so easy to do, and you need a lot of experience. And that is one of the beautiful use cases and examples where artificial intelligence really can help physicians find the most suspicious parts of the mammogram much faster, and also can help with guiding attention to potentially suspicious lesions, and thereby support physicians to make diagnosis in a more accurate way, and also look after more patients. So this is actually one of the really very real use cases which already make a difference for patients today.
Elizabeth, as a world globally, are we all going to work together on this so that we can get to the power of generative AI and its impact on the global world sooner rather than later? And I ask that because you have, as Tim reminded me, incredible experience working overseas, and especially in China in particular. You led the Siemens Healthineers business in Asia Pacific. There's just lots of experience with that at a time where there's lots of global tensions. I mean, just this week, we recently talked about technology rules and the EU model versus the US model versus the Chinese model and how it plays out. So give us some insight and smart narrative, if you will, or a smart narrative on how we need to think about this and what kind of collaboration we need.
Right. If you think about building high quality AI solutions which make a benefit for the patients, there is a few ground rules you have to follow. First of all, you have to make it easy for physicians to adopt the tools and the possibilities of AI in their tools. And secondly, and this is very important, you need high quality data, and you need lots of it. And in order to provide that strong foundation to build meaningful and impactful AI algorithms, you do benefit from leveraging a global network to collect the images, make sure you annotate the images in a good way that you can use them for training AI algorithms. So we collaborate with scientists and clinical partners all over the world. We've collected more than 1 billion images, and we then feed these images into our supercomputer, which is actually based in the United States, and we call the computer Sherlock because it helps us find the most relevant bits and pieces of information.
I want to go back to just talking about China because you did spend so much time in China. And I'm curious, Elizabeth, you must still know people on the ground there. We've talked so much over the last few months about the economic woes facing China. What are you hearing from your contacts there right now?
I mean, China is and always has been a very fascinating place for me personally. It's a place where I've spent a lot of time, where I keep going back to regularly. And I've always been really inspired by the energy and by the drive of the people in China, by the willingness to continue to build their country and their economy. Now, following the experience of the last 3 years with the very stringent COVID measurements, I mean, there is some thought process going on where people go back and say, well, maybe we could have done this differently as well. And people are feeling the impact now of the slower economy. At the same time, I continue to be optimistic and positive about China. The economy continues to grow, and I'm quite confident we will see it picking up again.
But on a corporate perspective, is China still the friend of EU corporations or companies in the EU, companies in the United States? Is there going to be that collaboration on things like new science or new technology?
I mean, for us, over the past years, we have moved focus into also understanding what do patients in China need. China has a population of 1.4 billion people, and these people need healthcare and want better healthcare. So we have added also R&D activities in China to our global network, and we continue to believe that for the benefit of patients globally, there is value in keeping the collaboration and working together on addressing some of the most challenging topics for mankind, like, for instance, addressing the threat of cancer.
Just one last question, and just got about 30-40 seconds here. How are you thinking about how AI could really change the way medicine works?
I see AI as a phenomenal opportunity because it will help us to address some of the most pressing needs that we're facing in healthcare systems. We don't have enough people. There is mistakes. The people grow older. There is certain diseases which become chronic. And in all of these areas, AI can and will make a difference. So to me, AI is really, it's not a threat. It's an opportunity. And if we make right use of it, it can help us focus us humans on what we do best and get the support of the AI to treat more people in more places and on a higher quality level around the world.
Elizabeth, I really appreciate your time. Elizabeth Staudinger, she is managing board member over at Siemens Healthineers, joining us on Zoom from Munich, Germany. Let's get to Nike earnings because the stock's up about 1.7% in the aftermarket.
Yeah, the revenue for the first quarter met the average analyst estimate. It came in at $12.94 billion. Estimate was for $12.99 billion. Looking at Greater China, Carol, because that's where my eyes certainly are. Greater China revenue coming in just below estimates, $1.74 billion versus estimates of $1.83 billion. Looking through what the company is doing in after hours, like you said, it's up about 1.8%.
All right, so 94 cents for the first quarter EPS. The estimate was for 75 cents. That looks like a big beat there. You said first quarter revenue pretty much in line. First quarter EPS 94 cents versus 93 a year ago. First quarter gross margin 44.2%. That was better than what the street was expecting, 43.7%. Again, bouncing around, still up about 1%. You know, we're looking at Nike. We'll look for more color. We're going to go through this earnings release because, you know, we've talked about the U.S. consumer. And Jefferies recently, did a downgrade on concerns about the consumer squeeze and also China woes. And we did see that China number coming in a little light. All right, you are listening and watching Bloomberg Business Week. This is Bloomberg Radio.
Join Brian Curtis and Doug Krisner at 6 p.m. Wall Street time for Bloomberg Daybreak Asia. Tonight's guests include Aaron Gibbs, Chief Investment Officer at Main Street Asset Management. That's Daybreak Asia tonight at 6 on Bloomberg Radio.
All right, folks, we're going to stay with Nike. Stock now up about 1.6% in the after hours following its earnings. We want to get a little bit more on the outlook. Looks like China revenue is a little bit light for the first quarter, but that EPS looks like a big beat. We're breaking it down for you, what you need to know when it comes to all things Nike. That's next.